Hey folks, Frank Cervilla here. I wanted to do a quick video in regards to what I believe is the most important thing when it comes to short-term trading, swing trading, which is risk management and position sizing. I think those are the two most important things when it comes to trading, and position sizing specifically is not widely talked about. And believe me, that's going to make a huge difference, if not the biggest difference in your trading. All right. So when I'm looking to buy a stock, I am looking to find something for the most part that has some type of momentum and then it's trading sideways, consolidating, okay? And then my interest is catching the second leg higher. So for example, INSP, here we have the momentum. Stock goes from 40 to 55 and then it goes sideways for roughly about 10 to 50, for about 10 to 13 days. And now it's breaking now again. Now, in the short term, I'm a believer that stocks move in short-term momentum bursts that might last 5 to 6 days, 1 to 6 days. Sometimes you might get a stock that might go up 10 days. That's rare. But the point is that they go up for 5, 6 days and then the momentum slows down. So that's the reason why I don't chase stocks and I don't buy stocks that are up multiple days in a row. INSP is a perfect example where here's a stock that goes from 40 all the way to 55 in a straight line, up 1, 2, 3, 4, 5, 6, 7, 8, 9, up 10 out of 11 days. It gets here to this level, which was prior resistance. This is when people were talking about a potential breakout, but a breakout like this is prone to failure. Okay, it's extremely important to know where a stock has come from before you consider one of these cookie type breakouts. Okay, this is no different than in real life. If, for example, it wouldn't be fair if you and I, if we're racing, and then you have to do 3 miles at full speed, and then then you and I, we're gonna race the 4th mile. I mean, you probably already spent a lot of energy. The same thing with stocks, that once they make these type of moves, they have spent a lot of energy. So you have to be careful when you're buying a breakout. You have to know where it's come from, okay? Because when you see something like this is prone to break out, and what's going to happen is that your expectations should not be for further upside, but more for sideways to down action so it can digest the move. Every now and then, you might come across a market environment like perhaps now or even back in August of 2018 where this might go a couple of more points, but it's not what we want. So either way, what I do with the swing trading is that I want to take advantage of the first 5 days. I want that momentum burst, okay? If for some reason, when I'm buying something like this, like INSP, it's got momentum, traded sideways for 10 to 12 days. When this thing breaks out again, okay, my expectations are for this stock to move immediately, okay? If it doesn't move immediately, it doesn't mean there's something wrong. It just means that maybe it's not ready yet, okay? So INSP, also, I want my original stop or my risk to be the highest in the first couple of days, okay? I want my risk to be the highest the first couple of days. So in other words, INSP, I'm long the stock at 55.35. My original stop was 51.60. That's roughly $3.75 away. Now that this stock has already made this move over here, now that the stock has made this move right over here, and it goes to 57.27, my stop goes from 51.60 to 54.80. So my original risk goes from 375 to roughly about 55 cents. And I'm doing all this without choking the trade. And the fact of the matter is, if this stock reverses and it goes to the low of the day, I no longer want to own this stock. And maybe that'll be a shakeout. We won't know. Or maybe it continues to go down like Yelp did just the other day. I don't know. But the point is that I was able to reduce my risk without choking the trade from 375 to roughly 55 cents. And that's what you want to do. So now if this becomes a loss, I'm down, 55 cents. It doesn't take a lot to make that money back on the next trade. Okay, so I can go out there and lose, 0.55 10 times and make it back with one trade that just gives me whatever, a old regular trade that goes up, 6%. And I think that's key because that'll make a huge difference in your P&L, your win-loss ratio, and in my opinion, it's all about the slugging percentage. How much money you make when you're right, and also how much money you lose when you're wrong. And if you're able to minimize the risk like I just did here, it's going to make a tremendous difference. Believe it or not, small gains, if you compound them quickly, okay, and you keep your losses minimal, they go a long way. I did the same thing with RETA, RETA. Down 3 days in a row. I bought the stock right over here at 76.19. My original stop was roughly 73.34. The stock closed at 77.02. My stop went up from 73.30 up to 73.78, right? Just a little bit. And then it continues to go up. I start to sell some on the way up, and I start reducing my risk slowly but surely. And let me tell you the type of difference it makes. Even if it's just a little bit over a bunch of trades, it will make a tremendous difference. So here we have an Excel sheet, okay, which you guys all have, which I told you to play around with this. So here we have a trader, okay, $100,000 account. He's a 50% trader. So far, 2-to-1. His average win is, 6%. Whoopie-doo, big deal. Average loss is 3%. So far, after 10 trades, he's up 1.5%. Okay, and that's with putting the same amount of money, roughly $10,000 into each single trade, okay, which is great. Now, let's just say, for example, NTNX just triggered. Let's just say, for example, that we are able to reduce these losses by just a little bit, not a lot. Just a little bit, because the stock moved in our favor immediately, and we raised the stop from the previous low to the, for the 3-day low to the low of the day of the breakout day. Let's just say we did that, and look at these stats: 1.5%, 2-to-1, 50% win-loss ratio. Okay, so let's go with trade number 16. Here, 53.30. Let's just say, for example, we're able to raise this stop to 53.80, 50 cents. Okay. Look at the difference it makes. Now we go up to 1.6%, and right over here, now we're at 2-to-1 trade, 2.1 to 1 trader, okay? And that's just by reducing just by a little bit. Let's just take this trade over here, number 23, right? Original stop is 940. Let's say, for example, we got stopped out minus 3% is 1018. Let's say we were able to come over here and just do 1030. 12 cents. Look at the difference. Look at the difference. Now let's just say we had one like INSP, and the stock goes up, and we're able to raise our stop to break even. So let's take number 20 here, and let's take this to break even. Now we're up 2%. Okay? Now we're up 2%, and we have a win-loss ratio of $2.40 for every dollar loss. Just by raising the stop, so this is not a big difference. I mean, just these two over here, and look what happened. Now let's just do another trade now. Let's say, for example, the next trade was a winner, and it's an $80 stock, so we can buy 125 shares. Add the trade, edit, and let's say we made 6% on this one, which is our, our win, our average win. So we sold the stock at 84.80. Look what happens. Okay? This is a big difference. This is huge. So you do this over a series of trades where you're minimizing your risk. The minute the stock moves in your favor without choking the trade, then it's going to be a win-win. And again, you want the first couple of days when you have the original stop to be the highest. That should be the highest risk. And it should be in those first couple of days. And as the stock starts to move higher, you start moving that stop slowly but surely. And what's going to happen is that you're going to get some stop outs, okay, but they're going to be minimal. And then just a regular win is going to pay for a lot of those small losers. Okay, so in my opinion, risk management position sizing are the two things you want to master, and they're the most important things when it comes to trading. And they're barely, no one talks about them, but they're the most important things in trading. So trade them well and be well.